I'm delighted and honoured to welcome Professor Larry H. Summers to be the keynote speaker for this concluding session. Larry kindly accepted the invitation to speak at the event, and he will give us his insights into the current macroeconomic outlook and its implications for policy. Larry, of course, needs absolutely no introduction to the members of the audience here, but briefly, he is President Emeritus of Harvard University. During the past 2 decades, he's held a series of senior policy roles, including Chief Economist of the World Bank, Director of the National Economic Council for the Obama administration, and Secretary of the US Treasury under the Clinton administration. And he's currently the Charles W. Eliot University Professor at Harvard University. Larry, a very big, warm welcome from everyone at the conference, and thank you so much for joining us. Just before we kick off, we'll try and leave plenty of time for a Q&A session at the end of this slot that will be mediated by my colleague Eddie Gerber from the Bank of England. So if you do have questions either now or during the session ahead, please post them in the chat box, and Eddie will kind of pick out the best questions and convey them to you, Larry, at the end. With that, perhaps we can kick off. So I was going to ask you to begin with about the topic of the day, the inflation outlook, both in the US and around the world, really, where we've seen large increases in inflation in many countries this year. Just this morning in the UK, the CPI inflation read, you might have seen, is the kind of biggest on record going back to when the Bank of England was granted independence for monetary policy in 1997. You've been very vocal about your view that overheating and inflation is the predominant risk to the US economy right now. Central banks, on the other hand, are quite sanguine about this risk. They view it as a transitory affair. Could you kind of start by kind of giving us your views on why you think this could be a more persistent phenomenon than central banks are expecting?
I think all of us, particularly when we're in policymaking positions, tend to want to make different mistakes rather than the mistakes we made before. And the dominant mistakes over the last 40 years have been of being overly worried about inflation, have been of being too restrictive for too long. And those were certainly the mistakes that were made in the wake of the financial crisis. And the inflation alarmists, of whom I've before now never been one, have pretty consistently been wrong. And there's been a feature of the data, which is that inflation has been low and constant for nearly 40 years, which means almost any econometric approach to the study of inflation will conclude that there's nothing that reliably predicts increases in inflation, because if you regress a constant term, a constant on any set of regressants, you're going to get zero coefficients. And so I think the intellectual environment, both in terms of the past experience of policymakers and the nature of the era that's considered relevant for statistical study, imparts a very substantial bias towards serenity. I think that there is a tendency, and a great deal of error in statistics comes from excessive emphasis on a particular null hypothesis. And something similar is, I think, true with respect to policymaking. We tend to go with a null hypothesis, which is what we thought before, until it's been proven to be wrong, at which point it's often too late to respond optimally. So I think all of these tendencies are running through central bank thinking. I think they're reinforced by the fact that there was an immediate imperative of providing liquidity and providing aggregate demand and providing economic support in the wake of COVID. And people who have an imperative tend to lose it somewhat slowly. So I think all of those things, along with the natural human desire to not inflict pain and to not be seen as a pain inflictor, all of that contributes to it being natural that if inflation were a problem, there might well be a tendency at this moment to miss it and to respond belatedly. If I look at the US economy, it seemed clear to me that when the gap in terms of lost incomes was running at about $30 billion a month below previous trend, with that $30 billion a month declining, it seemed to me obvious last January that we had a program that represented about $200 billion a month in stimulus. And that was coming on top of a $2 trillion savings overhang. And it was coming on top of record expansionary monetary policy. It seemed to me that we were headed for the bathtub overflowing, demand very substantially exceeding trend or potential output. To the extent that there was supply impairment because businesses closed, because there were early retirements, because people couldn't get to work, because certain sectors had to close, that only reinforced the bathtub overflowing by shrinking the capacity of the bathtub. So it seemed to me that there was a presumption that the bathtub was going to overflow. Nothing that has happened since then has changed that presumption in my mind at all. What has mostly happened is that we've had more evidence of more inflation more promptly than I would have expected. And so core CPI inflation in the US ran at a double-digit rate in the second quarter of the year. Now, of course, lots of that is transitory. So no one is suggesting that there aren't any transitory factors generating inflation. But the question is whether a norm is being established that is significantly above the 2% inflation target. That's what happened in the face of a much smaller fiscal expansion in the 1960s, setting the stage for the great inflation of the 60s and the 70s. Then the swing in fiscal policy was a quarter of what it has been in the last years. So I think what we have seen has been pretty rapid inflation. Now, of course, it's true that it's not even inflation. But if you imagine that demand was being overexpanded in a way where it collided with supply, what would you expect? You would expect that there would be some sectors where there would be major bottlenecks and they would have particularly large increases in inflation. And that's kind of what we have seen. Is all this going to end? Is it going to end quickly? Is inflation going to return to normal, consistent with a rapidly growing economy? Maybe, but it's interesting that the median inflation, the thing that strips out all the outliers that people used to emphasize, it had its worst month in 14 years last month. So that's not so encouraging. The businesses I talked to and the surveys of businesses report that people now think bottlenecks are going to be part of their economic environment until mid-2022. But the two biggest markets in the economy, the labor market and the housing market, both, it seems to me, are cause for alarm. Nobody disputes that the labor market's getting tighter and tighter and tighter. And yet already we've got the highest vacancy rate we've ever seen in the United States and the lowest rate at which employers are able to fill vacancies that we've ever seen in the United States. That seems to me to presage wage acceleration. Now we look at the housing market. House prices are up almost 20% year on year. If you look at new tenants moving into rented housing, they're paying 17% more than the previous tenant did. That tells you that we've got some kind of rapid housing inflation, and that's the largest component of the CPI. It's not in the statistics yet, but either it's coming in the statistics or it says something about the quality of the statistics, because nobody can really argue that housing costs aren't going up very substantially. So I look and I see more tightness in labor markets, more pressure coming from housing markets, continued presence of bottlenecks, more fiscal policy coming on line, and no plans to raise interest rates until 2023, and a change in the Fed's doctrine from we're going to remove the punch bowl before the people get plastered to we're going to remove the punch bowl only when we're absolutely sure that there are a lot of people getting plastered. And it seems to me that people are going to be revising upwards their view about inflation expectations. Now, could I be wrong? Of course I could be wrong. Demand could create its own supply. We could have some substantial interruption in economic activity from some other source. I don't think COVID isn't going to be enough to make me wrong, because I think that at this point, more COVID is acting as much as a supply shock as it is a demand shock. And therefore, it could be a potential contributor to inflation. So I'm pretty worried about the inflation picture right now. It's remarkably reminiscent to me of the 1960s. First there's denial that there's inflation. Then there's explanation that inflation's due to a set of special factors. Then there's an increasing view that maybe some inflation's okay, or at least inflation's okay relative to the consequences of trying to curtail inflation with policy. So I'm anxious. I have to say, this is a financial conference. I have to say I'm quite surprised and puzzled that my concerns are not more manifest in the bond market. It is true that break-even inflation rates have picked up, but they haven't picked up that much. And I'm not with a completely clear explanation as to why that is.
You mentioned the kind of policy framework changes. Maybe I'd be keen to get your views on this. So, of course, the Fed's changed its framework. It's now kind of committed to allowing inflation to overshoot 2% to make up for past undershoots. The motivation for this was all kind of looking back to when we had deflationary pressures as the primary concern, the proximity of the effective lower bound, and so on. Are you concerned, though, that this change kind of risks baking in the Fed being behind the curve? Is it really well equipped to deal with the risks that you see? How concerned are you?
I think it's usually a mistake to, I guess I have a kind of one, almost a meta view, and then I have a more specific view. I think it's in general a mistake to respond as a policymaker to demands for clarity about future actions. It is easy to say that transparency is a good thing. It is easy to say that people want to understand and it's good to give people more information. But the reality is that we live in a world of unknown unknowns. We don't know what's coming. And so it's very difficult to specify our reaction functions. And so setting specific targets, you have to balance the extra information and clarity that you may be providing against the risks to your future credibility or the risks to your future ability to optimize. Because when you make a statement of intention and something unexpected happens, then you either have to carry through on what you said, which may not be what you want is best to do under those circumstances, or you may have to be in the position of sacrificing your credibility and explaining that something new has happened. So I think that a past generation of central bankers, typified by Alan Greenspan, understood what the Delphic oracles understood, which is that if people think you're omniscient and omnipotent, but you're really not, it's a good idea to speak with a certain oracular vagueness rather than with a certain numerical precision. And I think we have an era in central banking that is confused on that kind of point. I think the average inflation targeting was a device for providing credibility to the idea that policy would be looser longer. Mm-hmm. And maybe it contributed a bit to that. I'm not sure that rates at any point have been lots lower than they would have been in the absence of that policy. And I think it doesn't make a lot of sense when you have an instrument that operates with a year or a year and a half lag to say that you're only going to respond in response to events and not in anticipation of events. So I'm not very enthusiastic about the new framework, though I understand the pressures that led to its adoption.
That's very good. I was wondering if we could turn to the implications of all this for fiscal policy sustainability, and kind of what that means then for central bank independence, that nexus of issues. I guess it's no surprise with the increase in public debt, the enormous increase we've seen, that public debt service ratios are going to be very, very sensitive to interest rates, which they are right now. QE has heightened that effect by removing maturity from private sector balance sheets and shortening the effective maturity of the government's liabilities. What are your thoughts on the risks of an inflation spike spilling over into a public debt crisis, or do you think central banks have enough independence to kind of take the necessary actions to head off an inflation persistent inflation increase, given what that would mean for public debt sustainability?
Look, I think you're raising the set of issues that I think is most important for macro financial researchers to be thinking about right now in order to illuminate policy debates. And I don't pretend to have all the answers, and I don't pretend to have views that I won't have changed over the next year. I'd make these observations. First, at the time the Maastricht criteria were propounded, real interest rates in Germany were in the 4 to 5% range, and nominal interest rates on 10-year bonds were in the 7 to 8% range. Mm-hmm. And almost any theory of borrowing would tell you that the reasonable and appropriate level of borrowing is attentive to the interest rate environment in some combination of nominal and real terms. And so whatever one thought about fiscal policy some years ago, it seems to me that it's appropriate to have more expansionary monetary policies, more expansionary monetary policies today, more fiscal policies today. And I think that point may be insufficiently appreciated. Second, I think it is reasonably clear that there are a set of structural factors that mean that apart from extraordinary events, near wartime events, like the response to COVID, that we have had a set of structural changes that have raised the propensity to save, raised perhaps the propensity to take on to avoid risk, and reduce the propensity to invest and to bear risk. And that has led to substantially lower neutral interest rates. And I think all of that means that we probably in this period need to think about deficits somewhat differently than we have in the past, both because there's likely to be more sustainability than there once would have been, and because there is more need to absorb saving. And that the issue of savings absorption was, I think, the central macroeconomic issue of the pre-pandemic decade. I think we mostly didn't recognize it, and therefore we had an excessively protracted recovery relative to what we needed to have. And I don't think it's clear where we're going to be in the aftermath of wartime levels of fiscal and monetary support during COVID. I do think that this issue of savings absorption is likely to be an important issue on a continuing scale. How much room we have to expand fiscal policy without pushing interest rates up is, I think, an absolutely crucial question. And I don't pretend to have a settled view on it. It is, I think, a very striking thing, the way in which interest rates have risen. And we have not seen, the way in which deficits have risen, and we have not seen corresponding increases in real interest rates.
Yes, yes. Perhaps we could we could turn to some of the more global aspects of the environment we're seeing. There's a recent column in the FT by Geeta Gopinath, who expresses the concern that, another taper tantrum style episode would be disastrous for emerging markets and developing economies. I'd be interested in your views on how the Fed can begin to taper its asset purchases while mitigating that risk of huge spillovers for the rest of the world, or more generally, what are the spillovers you see from this period of US largesse, fiscal largesse for other countries?
I read Geeta's piece closely, as I read everything she writes, and I have enormous respect for her and the IMF. I must say I did have slightly the perspective that they want to make sure we don't have inflation because that would be dangerous, and they want to make sure we don't have tapering because that could be dangerous. And having warned about all the risks, it seemed to me that the essence of policy making is deciding which risks to emphasize and which risks to place less emphasis on, not to simply point up all the various risks in the situation. My own view is that whenever the Fed stops tapering, it will be the starts tapering. Mm-hmm. It will be the most heralded change in monetary policy in the history of the planet. They discussed planning, the process of planning to plan. Then they discussed planning to plan. Now they're discussing planning. By the time it happens, it's hard to believe that it's going to set off any shockwaves in markets. And I'm not sure just how large the effects of QE have been on interest rates. So I don't think that I think the largest risks to the developing world come from what has always been a source of risk to the developing world, which is the industrial world losing control, overexpanding, suffering overheating inflation, and having to hit the brakes hard. And so it seems to me that it is delayed action that is much the greater risk for the developing world and emerging markets, rather than overly accelerated action.
I see. Okay, my final question for you, briefly. We have in the audience for this event, we have a lot of young economists, and I think they'd be very interested, for those people working in macro, what topics, you've already touched on public debt as one topic. What would you like to see more focus on going forwards?
I have, when I was a policymaker, I read, I believe, every NBER working paper on a macro topic, with the exception of any paper that used the word DSGE, because I didn't think, my experience with papers that used the term DSGE was they derived very specific conclusions from premises that were no more than allegories. And so I found much more interesting papers that put forth a different interpretation of events, or that pointed up a hypothesis or offered an explanation for a correlation, rather than papers that were put in a methodological straitjacket of some sort. So that's got one type of suggestion for researchers. I think one of the very large phenomena of our moment is the extraordinarily low level of real interest rates, both right now and in prospect. And it seems to me that that is pregnant with implications. What does it say about the social marginal productivity of investment? If you think that the safe real interest rate has something to do with the certainty equivalent marginal product of capital, that number is remarkably low. What does it say about asset pricing? How do those very low interest rates affect patterns of asset pricing? What is the implication? What are the causes of this extraordinarily low level of real interest rates? What does it mean for various traditional thinking about corporate finance and debt equity behavior? How should we think about it? How should we think about a world of high debt ratios and low debt service ratios in terms of our concerns about financial stability? What does it say about the implications for the capital markets functioning and efficiently allocating resources if interest rates are so low that debt service payments don't represent a significant barrier, and so people who are in business can stay in business for a long time? Am I right in my broad vision that the macroeconomic problem of the 1980 to 2010 period was the maintenance of discipline and the avoidance of the temptation to inflate, and that the macroeconomic problem of our era is the absorption of all the saving in a world where there is much less demand for physical capital because so much IT can be produced so cheaply, because so much of what is valuable is not tangible or is of low mass. These seem to me to be very fundamental kinds of macroeconomic, macro finance questions. I think the other set of issues that I would point up is, I think the paradigm in which we have operated for the last almost 2 generations now has been a paradigm in which stabilization policy is all about the second moment of output. What policy is about stabilizing it, because of course it's all about price rigidities, and nominal things don't affect real things in the long run. And so if you can go above or you can go below, but what you're trying to do is to control the second moment. That's not why I went into macroeconomics. I went into macroeconomics because I thought that better stabilization policy could avert busts without also shaving off booms to an equal extent. I believe that the Great Depression didn't have to happen. I believe that the 2008 financial crisis didn't have to happen. And so a set of theoretical and empirical constructs in which it is admitted as a logical possibility that better macroeconomic policy can raise the mean level of output and reduce the mean level of unemployment over time, rather than merely affect the amplitude of the fluctuations. It seems to me that is the other frontier that I think is extremely important.
That's, I think, a really inspiring set of issues for PhD students. Really big, meaty issues for PhD students to work on. Adi, I'm going to hand to you to, maybe pick the best couple of questions from the audience, and Larry, if you'd be kind enough to address those.
Thank you very much, David, and thank you very much, Larry. And actually, maybe continuing on your last point that you were encouraging young economists to work on, I have two questions on monetary policy from two different angles. So the first question is whether kind of what your view is on the optimal / most desirable policy mix to deliver a given amount of monetary normalization. So what are the merits in the current environment of higher policy rates versus unwinding the central bank balance sheets? That's one question. And if I may squeeze in the other, and continuing kind of what you were commenting on the Fed's monetary policy review, whether you had any views on the ECB's new strategy on inflation targeting post-COVID.
I don't follow the ECB as closely. I think the move by the ECB to a symmetric approach around 2 rather than a peak of 2 seems to me to be an appropriate and wise step in light of it. And that's the only aspect I feel well enough informed about to comment on. I think in general, the right approach is to scale back QE first. I don't really understand the logic of QE in the current context. It's important to recognize that QE is debt shortening. QE is terming in the debt. If I encountered a homeowner who had a 2% fixed rate mortgage or 2.5% fixed rate mortgage, and they explained that they were going to trade it in for a adjustable rate mortgage that had daily fluctuations in its interest rate because the current daily interest rate was very low, I would think that was an extremely surprising decision. And so for major governments around the world, in the face of what seems to me to be immense uncertainty and remarkably low rates, to be terming in their debt seems to me to be a quite surprising choice. Insofar as it has consequence, the consequence, it seems to me, is to inflate asset prices at a time when it's hard for me to believe that costs of capital are an important constraint on investment. And so I think you're pumping up existing asset prices to very little benefit in terms of aggregate demand and substantial cost in terms of inequality. So I think as a generally principled matter, when I enter a room through a door, I usually exit through the same door. So I'm inclined to think that whatever the policy you pursue is on the expansionary side, usually lowering rates to 0 and then doing QE, there's at least some presumption that that should be the approach you take on when you're moving in the other direction. But that presumption under certain circumstances might be rebuttable. But in current circumstances, where it seems to me there are a number of perversities associated with QE, it seems to me the case for that view is almost overwhelming.
Can I just jump in on a follow-up there? So you were mentioning the asset price inflation. So according to you, how worrying or worrisome is the current asset price inflation that we see across asset classes? Do you have any view on that?
I think it is worrisome. I think one needs to be a little bit careful. My own reading of the evidence is that if you look at equity prices, they are quite extraordinary, measured relative to earnings and dividends, but rather, or sales or anything else like that, but they're rather less extraordinary when measured against earnings and interest rates. And so if one takes as a given a remarkably low safe rate, then equity prices actually do not look especially aberrant right now. And so that tempers my concern. My concern as a policymaker is also tempered by humility. Or for that matter, my concern as an investor is tempered by humility. That it seems to me that it's very difficult to spot bubbles. Alan Greenspan proclaimed irrational exuberance in December of 1996. In retrospect, there was not a bubble in 1996. It was an almost universal view that the crash of 1987 took place from previous bubble levels back towards more normal levels. But if one looks at a graph of stock prices today, one is much more inclined to see the crash of 1987 as an air pocket amidst a long-term trend than as reflecting a prior bubble. So I think that the answer is yes, I'm concerned and apprehensive, but I'm also possessed of substantial humility. I think more investors have lost money over time, spending too much time outside the market and missing rallies, than have saved themselves by liquidating early. And I think that policymakers would need to be very sure of themselves were they to pursue active policies of pricking bubbles.
Thanks a lot.
Larry, I gave your assistant my word that we would release you at 1 p.m. your time, because I know you have a very busy day ahead. So let me just, on behalf of everyone in the audience, really kind of thank you for some fascinating insights and a virtual hand clap across the ocean.
Thank you very much.
Thank you very much indeed.